Hello and welcome back to Explain the Charts, your go-to channel for detailed market analysis. Today, on October 12th, 2025, we're diving deep into the USDCAD, also known as the loonie, which is currently sitting at a very interesting technical juncture. First, we'll cover the crucial news events that have been driving the price action, and then we'll jump into a multi-timeframe analysis of the charts. The biggest story right now is the recent Canadian jobs report from 2 days ago, which came in dramatically stronger than anyone anticipated. The economy added 60,400 jobs, crushing the forecast of just 5,000, which sent a shockwave through the market. This unexpectedly robust data has significantly impacted monetary policy expectations for the Bank of Canada. Before the report, the market was pricing in a 72% chance of an interest rate cut at the next meeting. That probability has now dropped to 57%. Fewer expected rate cuts is fundamentally bullish for a currency, which is why we saw the Canadian dollar strengthen and the USDCAD pair move sharply lower. However, the broader macroeconomic picture is more complex. The US dollar has been in a period of general strength, fueled by expectations that the Federal Reserve will remain less dovish than other central banks like the Bank of Canada. Furthermore, as a commodity-linked currency, the Canadian dollar is heavily influenced by oil prices, and recent weakness in crude has been a headwind for the loonie, providing underlying support for USDCAD. There's also political uncertainty on both sides of the border that could add to volatility in the coming months. Now, let's bring up the daily chart to see how these fundamentals are reflected in the long-term price action. As you can see, despite some recent pullbacks, USDCAD has been in a clear and powerful uptrend since the lows we saw back in late summer of 2024. The market has been consistently printing higher highs and higher lows, which is the classic definition of a bullish trend. The price is currently consolidating near the 1.40 level after reaching a multi-month high just a few days ago. This 1.40 to 1.41 zone is a major area of psychological and technical resistance. Looking back to late 2024 and early 2025, we can see the price struggled and topped out multiple times in this area, specifically with peaks near 1.4245 and the major high of 1.446 back in December. This level, around 1.44, is what some analysts are calling a potential ceiling for the pair in 2025. On the support side, the recent low from the jobs report news around 1.3970 is the most immediate level to watch. Below that, we have potential support zones around 1.3890 and the more significant 1.3827 area. One thing to note on this daily chart is the extreme volatility we've seen on certain days, with massive wicks to the downside. Look at these candles on November 15th, December 20th, and January 10th. These represent either data errors or brief, violent flash crashes that were immediately bought back up. While potentially anomalous, they highlight that this pair can be subject to extreme moves, but also that there is significant buying demand at much lower prices. This reinforces the idea that the underlying long-term trend remains bullish, as dips have been aggressively purchased. Let's switch over to the 1-hour chart to get a closer look at the recent price action, especially the reaction to that jobs report. Here we can see the price was trading comfortably above 1.40 before the news hit. On October 10th, we saw a very sharp, impulsive move to the downside as the strong Canadian data was released. The price fell from a high of over 1.4030 down to a low near 1.3974 in just a couple of hours. This confirms the market's immediate bearish reaction to the news. Interestingly, technical analysis from sources like Investing Live pointed to a key support zone between 1.3966 and 1.3970, which is precisely where this sell-off found its footing. Since hitting that low, the price has managed to bounce and is now consolidating in a tight range, mostly chopping around the 1.40 handle. This indicates a state of equilibrium, where the bearish shock of the jobs data is being balanced by the longer-term bullish factors we discussed earlier. The market is essentially undecided right now, waiting for its next catalyst. To get an even more granular view of that news-driven move, let's zoom into the 15-minute chart for October 10th. I'm filtering the chart to show the price action right around 12:30 Universal Time Coordinated, when the Canadian jobs data is typically released. You can see the price was relatively calm, and then, right on schedule, we get this massive red candle, representing the immediate, powerful selling pressure. Within a single 15-minute period, the price dropped significantly, followed by further downside in the next hour. This is a classic example of how fundamental news can drive technical moves. Following the initial drop, we can observe the bounce from the lows and the beginning of the consolidation we see on the hourly chart. Watching price on these lower timeframes during news events is key for short-term traders to gauge market sentiment and reaction strength. So, putting it all together, what are the potential scenarios from here? Let's go back to the daily chart to frame the possibilities. For the bullish case, traders are looking for the price to successfully hold above the critical 1.3960 to 1.3970 support zone. If buyers can defend this area and push the price back above the 1.4030 highs, it would invalidate the bearish impact of the jobs report and suggest the long-term uptrend is resuming. A confirmed break above this resistance would open the door for a test of the 1.4100 level, and beyond that, the December highs around 1.4245. This scenario would be supported by renewed weakness in oil prices or any dovish hints from the Bank of Canada. On the other hand, the bearish case hinges on a failure to hold current levels. If sellers take control and push the price decisively below the 1.3960 support, it would signal that the recent top was significant and a deeper correction is underway. This would be the first major sign of a short-term trend reversal. A break of this level would likely lead to a test of the 1.3890 level, with the next major target being around 1.3827, as some analysts have suggested. This bearish scenario would be strengthened by continued positive Canadian economic data or a broader sell-off in the US dollar. To recap, the price action in USDCAD is at a critical inflection point. The key levels to watch are resistance at 1.4030, followed by 1.4100, and the major ceiling near 1.4400. Crucial support lies at the 1.3960 to 1.3970 zone, and a break below that targets 1.3890 and 1.3827. Given the strong underlying trend, but the recent fundamental shock, I'd assign a 60% probability to the bullish continuation scenario, where support holds and we eventually challenge the highs. This is based on the powerful multi-month trend and the overarching theme of diverging central bank policies. However, there is a very real 40% probability of a bearish reversal if support at 1.3960 fails, as the strong jobs data cannot be ignored. Moving forward, keep a close eye on upcoming inflation reports from both Canada and the US, any speeches from Fed or BC officials, and the price of crude oil. These will be the catalysts that determine whether we break higher or reverse lower from this pivotal point. Thanks for watching this analysis on Explain the Charts. Please remember, this video is for informational and educational purposes only and should not be considered financial advice. Trading involves significant risk, and you should always conduct your own thorough research before making any investment decisions.